The promise of insurance is simple. You pay every month. They protect you when things go wrong. Risk is pooled. Costs are shared. Everyone wins. At least, that's how the idea was born. But over the last 40 years, something fundamental happened. Insurance didn't collapse. It didn't disappear. It didn't fail all at once. It shifted slowly, quietly, mechanically to something unrecognizable. A system designed to protect people began protecting itself. And this is the story of what happens when insurance stops working. Not because there isn't enough money, not because disasters got bigger, but because the incentive structure behind the entire industry changed in a way almost no customer ever sees. Insurance began as a mathematical idea: spread risk across many people so no single person gets destroyed by chance. And it worked for centuries. House fires, shipwrecks, accidents, medical emergencies. Small, predictable risks and rare, catastrophic ones were all absorbed by the group. Then, the modern world evolved. Healthcare costs exploded. Lawsuits became incredibly expensive. Climate disasters escalated. Technology created entirely new forms of loss. Risk wasn't stable anymore. It grew faster than companies could model us. And that's when the first cracks began to appear. Insurance companies, at their core, are private businesses. They survive by charging more in premiums than they pay out in claims. It's a simple formula. But when risk grows faster than revenue, companies face a choice. 1. Raise prices. 2. Reduce payouts. Or 3. Redesign the system. Over the last 4 decades, most companies quietly chose all 3. Premiums rose faster than wages. Deductibles exploded. Exclusions multiplied. Coverage shrank. This didn't happen through one big reform. It happened policy by policy, year after year, until the product people thought they were buying was no longer the product they were promised. Let's look at the numbers behind this shift. In the US alone, the insurance industry takes in $1.4 trillion a year in premiums. That's a staggering amount of money. Yet, since 2010, claim denials are up by 57%. The average deductible in the year 2000 was around $450. Today, it's over $1,700. Out-of-pocket healthcare spending is up 230% in just 20 years. And satisfaction with health insurance is at its lowest point in nearly 3 decades. But here's the most revealing data point. 1 in every 6 claims is denied for procedural reasons. Not because the claim isn't valid, but because of paperwork, a missed deadline, or a technicality. Insurance isn't failing due to a lack of funds. It's failing because denying claims has become a profitable business model. When you file a claim, the outcome depends far less on fairness than it does on the system's structure. First, you have pre-authorization barriers. This means your doctor has to get approval for a treatment before it can even happen. Last year, 48 million Americans had a treatment delayed or denied because of pre-authorization. Next are the exclusions hidden in the fine print. Your policy might say you have coverage, but only under very specific conditions that most people never read or understand. Then there are narrow networks. Your plan might promise a low premium, but it only allows you to see doctors from a shrinking list. This forces you to choose between an in-network doctor who might not be the right specialist and paying thousands out of pocket for someone who is. A common tactic is also to delay claims into exhaustion. The company asks for more documents, then more, delaying again and again until many people just give up. And a new worrying trend is AI-powered denials. Some companies now use automated systems to deny claims in seconds without any human review. In a normal market, treating customers this way would destroy a business. But in insurance, reducing payouts actually increases profit. It's a structural flaw built right into the foundation. And there's another shift happening just beneath the surface. Certain risks are becoming too unpredictable for traditional insurance. Think about climate risk. Fires, floods, heat waves, and storms have doubled in frequency in just 20 years. In 2020, there were 22 separate billion-dollar disasters in the U.S. By 2023, that number had jumped to 28. In 2022 alone, insurers paid out over $100 billion in natural disaster claims. As a result, farmers in the Midwest are losing coverage. Homeowners in California are being dropped. Coastal homes are becoming uninsurable. When risk becomes this massive and unpredictable, the insurance model cracks. Customers are seeing the symptoms everywhere: rising premiums, shrinking coverage, confusing policies. Unpredictable bills, denied claims, and aggressive collections. What they don't see is the underlying equation. Insurance companies optimize for risk, but only the kind that affects them, not the customer. They reduce their own exposure by shifting liability, increasing deductibles, limiting networks, and raising premiums. The product looks the same on the outside, but its purpose has completely changed. The result: fewer and fewer people trust the very system that was designed to protect them. We assumed modern analytics, AI, and automation would make insurance smarter. And they did, but not in the way people expected. This powerful technology wasn't used to make coverage better or more affordable for you. It was used to analyze risk at a microscopic level, to identify high-cost customers, to predict who is likely to file claims, to automate denial letters, and to optimize contracts for maximum profit. The efficiency gains weren't passed down to customers. They were captured by the companies. Let's compare this to other countries. In places like Germany, Japan, and France, health insurance exists, but it operates under strict regulations. If a claim is denied, the company has to justify it. If a premium rises, it's capped. The government intervenes to keep the system fair. Their incentives are aligned with public health. The United States pays 2 to 4 times more for worse health outcomes. Not because Americans are sicker, but because our structure allows for endless cost escalation. It's the same with home insurance. After an earthquake, Japan uses pooled national risk funds to rebuild. In California, families are left to negotiate with private insurers. The structure is destiny, and our structure has changed. This brings us to what I call the illusion of coverage. There's a hidden truth inside modern insurance that almost no one understands. You can be fully insured and still be completely unprotected, because coverage isn't a guarantee. It's a conditional promise, wrapped in layers of fine print. On paper, your plan might list thousands of doctors and hundreds of treatments, but the real question isn't what's listed, it's what's actually approved. Insurance doesn't deny care by simply saying no. It denies care through something much quieter: prior authorization. It's a process where your doctor must ask for permission from someone who has never met you, never examined you, and whose job is not to heal you, but to evaluate cost. In 2023, 35% of all patients experience delays because of this. 1 in 4 doctors said these delays caused serious harm to their patients. The system knows that if they delay long enough, many people will just give up or pay for it themselves. Insurance isn't protecting health. It's protecting budgets. The gap between what you think you're paying for and what the system actually delivers is where suffering grows. Behind every insurance company, there's a second, even more powerful company: the reinsurer. They insure the insurers. Huge global firms like Swiss Re and Munich Re. These are the companies that ultimately decide which risks are acceptable. And over the last decade, reinsurers have started walking away from entire categories of risk: wildfire zones, hurricane zones, higher-risk industrial sites. When a reinsurer exits a market, the insurance companies that rely on them exit too. This is why entire regions suddenly lose coverage. It's not a local decision, it's a global market shift. So what happens when insurance stops working? Risk shifts back onto families. Disasters destroy wealth instead of being absorbed by the system. Businesses fail after a single accident. Healthcare becomes a luxury. Homeowners become financially stranded. Climate risk becomes a personal liability. A system built for predictability is now facing an era of extreme volatility, and volatility breaks insurance faster than anything else. Insurance didn't collapse overnight. It drifted, decade after decade, into a new identity. A system designed to absorb shocks learned to avoid them. A system designed to protect people learned to protect itself. A system built on shared risk became a system of selective risk. It didn't stop working because people made bad decisions. It stopped working because the structure incentivizes it to fail. For most people, insurance is still a safety net. But for a growing number, it's a maze of exclusions, denials, and rising costs. Not because the original idea was flawed, but because the incentives have fundamentally changed. When the cost of protection becomes its own risk, the system built to keep society stable starts shaking the ground beneath our feet. Insurance didn't break by accident, it broke by design. And the longer these incentives remain misaligned, the more the system will drift away from the very purpose it was built for. Thanks for watching. If this story resonated with you, consider subscribing for more deep dives into the systems that shape our world.